Your children could inherit your debts instead of your dreams. I'm Ayo Noble, and I've seen too many families where parents thought that they were providing for their children only to leave them with financial burdens that destroyed their futures. In this video, I'm going to show you the stark difference between children who inherit money versus children who inherit problems. This isn't about being wealthy, it's about being responsible. By the end, you'll understand how to ensure your children start their adult lives with advantages and not debts. As a parent, everything you do is for your children's future. You work long hours, you make sacrifices, and you dream of giving them opportunities that you never had. But what if I told you that without proper planning, you could be setting them up for financial disaster instead? Last month, I worked with a 19-year-old whose father had just passed away. Instead of inheriting security, she inherited a £45,000 debt in the form of a mortgage she couldn't afford and the added responsibility of looking after her younger brother. Her university dreams? Gone. Her future? Derailed by debts she never created. Now let's compare that to another client whose father had passed away in the same week. This 19-year-old inherited $200K tax-free, a paid-off family home, and the freedom to pursue any path she chose. Same age, same tragedy, completely different outcomes. In this video, I'll show you the hidden ways children inherit their parents' financial problems, real stories of families destroyed and families protected, the exact cost of leaving your children unprotected, how to guarantee your children inherit opportunities and not obligations, and why this matters more than any university fund you could ever create. But first, let me ask you a question that every parent needs to answer. What legacy are you actually leaving behind? Most parents think debt dies with them. They're wrong. Here are the ways your financial problems become your children's burden. Number one, the mortgage trap. Your mortgage doesn't disappear when you die. If there's no life insurance to pay it off, your children face impossible choices. The first choice is to take over payments they can't afford. The second is to sell the family home and split the proceeds, if any remains after they've paid off the mortgage. Last option is to watch the house get repossessed, destroying their credit if they're actually named on any of the documents. You see, I worked with a family where the father died with 15 years left on a £280,000 mortgage. His two children, aged 22 and 25, inherited the house but couldn't afford the monthly payments of £1,400 a month on their combined income of 45k. So they had to sell their family home, the place where they had both grown up. So after estate agent fees and the outstanding mortgage balance, they both received 18k each, which wasn't enough for a deposit on a flat, let alone maintaining their family's legacy. The second thing of note is the credit card catastrophe. While children don't directly inherit credit card debt, they inherit the consequences. And this happens in the following ways. Number one, estate assets get used to pay off debt before any inheritance. Number two, the family home might need to be sold to clear these debts. Number three, children receive nothing while creditors get paid first. Now, this reminds me of one client's father who died with £35,000 in credit card debt. The family thought the house being worth 200k would provide security. After paying off the debts, the legal fees, and estate costs, the children inherited 140k split between three siblings. Each received 46,000 instead of the 66,000 they expected. That small debt cost them £60,000 in total inheritance. The third issue is the business debt disaster. If you're self-employed or own a business, your children could inherit massive problems. And these could be any of the following: personal guarantees on business loans, tax liabilities from the business, ongoing business obligations they can't fulfill, and legal responsibilities they don't understand. I've seen children forced to declare bankruptcy because they inherited business debts their parents had personally guaranteed. One 24-year-old inherited a 120k tax bill from her father's failed business. She had to sell her own flat to pay debts she never knew existed. The next problem, which you probably guessed, the funeral debt. The average UK funeral costs £4,141. But many families spend between £6,000 to £8,000. If there's no money left behind, guess who pays? Your children. I've worked with families who went into debt just to bury their parents with dignity. One family took out an 8k loan with a 29% interest rate just to bury their mum. They're still paying it off 3 years later with total payments exceeding 12k. The next problem is the care home clawback. If you need care in your final years, the local authority can claim money back from your estate, even after you die. This can devastate inheritances. Care costs can average around 35k per year. Local authorities can claim against property, and children might inherit nothing after care costs are deducted. One family thought they would inherit their father's 300k house. After 5 years of care home fees, the local authority claimed 175k from the estate. The children inherited 125k instead of 300k. A loss of 175k pay that proper planning could have prevented. And finally, the tax trap. Inheritance tax at 40% kicks in on estates over 325,000 or 500,000 if you're leaving your home to your children. Without planning, your children could face massive tax bills. So why is this a problem? Well, tax must be paid before probate is granted. Children might need to borrow money to pay the tax, and assets might need to be sold at unfavorable prices in order to raise cash quickly. I worked with a family who inherited a £600,000 estate. The inheritance tax bill was £110,000. They had to sell shares during a market downturn to pay the tax immediately, losing an additional 25k in the process. Poor timing cost them 135k in total. Let me share two real stories that perfectly illustrate the difference that proper planning makes. The first story is about the unprotected family, the Johnson story. So Mark Johnson's 45. He worked as a sales manager earning 55k. His wife Lisa worked part-time earning 18k. They had two children, Emma who was 16 and James who was 13. They owned a 350k house with a 220k mortgage. Mark always said he'd sort out life insurance next year. He was young, healthy and felt invincible. However, he never got the chance. When Mark died suddenly of a heart attack, here's what happened to his family. So the immediate impact was that there was lost income of 55k per year, mortgage payments of 1,200 per month now got left with his wife, Lisa. Lisa's part-time income was only 1,500 per month. So as you can see, there was a monthly shortfall of £2,200 a month. So between month 1 to 3, funeral costs, 6.5 grand paid with credit cards, mortgage payment, holiday granted. Lisa tries to increase her working hours but couldn't due to childcare needs. Then from month 4 to 12, mortgage payments resumed. Lisa couldn't afford the payments on her income. Credit card debt accumulated to cover shortfalls, and Emma had to get a part-time job instead of focusing on A-levels. And then by year 2, the house was repossessed after missed payments. Family moved to a 2-bedroom council flat. Emma's university plans were cancelled because she couldn't afford it. James changed schools, affecting his education, and the total debt accumulated was 35,000. So what are the long-term consequences? Well, Emma works in retail instead of pursuing her dream of becoming a teacher. James struggles academically after the disruption. Lisa suffers from depression and anxiety, and family relationships were strained by financial stress. So the estimated lifetime impact is over $500,000 in lost opportunities and accumulated debt. So what does it look like for the protected family? Well, the protected family are called the Williams. So here's the Williams story. David Williams, age 44, worked as an engineer, earning 52k a year. His wife Sarah worked part-time, earning 16 grand a year. They had two children, Sophie, who was 15, and Tom, 12. They owned a 340k house with a 210k mortgage. David had 400k worth of life insurance, costing him £38 a month. It's less than our family phone bill, he told Sarah when they set it up. When David died in a car accident, here's what happened to his family. So what's the immediate impact? Well, the family lost 52k per year. Life insurance claim submitted immediately. Employer provided 3 months salary continuation. And in the first 2 months, the funeral costs were $7,500. So the family chose a beautiful service to honor David. The life insurance paid out 400k tax-free. No financial stress during the grieving period. And from month 3 onwards, the mortgage was immediately paid off. 210k straight to the mortgage. Remaining funds invested conservatively, so 190k invested. Investment income was £380 per month. Sarah's part-time income is £1,300 per month. No mortgage payments, meaning that she's saving £1,150 per month. And the total income is £1,680 versus £1,200 expenses. So what are the long-term outcomes? Well, Sophie excelled in her A-levels without work pressure. She then secured a place at university to study medicine. Tom continued his education uninterrupted. Sarah could focus on supporting her children through grief. The family also remained in their home and community. University funds were secured for both children, and the estimated lifetime benefit over 800k in preserved opportunities and financial security. So what was the difference between these two families? £38 a month in life insurance premiums. That is less than what most families spend on streaming services. So you might ask, so what is the ripple effect? Well, the ripple effect is that the impact goes beyond just the immediate family. And we can see it here. Emma Johnson, who was unfortunately unprotected, left school at 18 to work full-time, never went to university, earns 22k at the age of 25, lives paycheck to paycheck, and can't afford to help her own future children. Whereas we look at Sophie Williams, who was financially protected. She completed medical school. She's now earning 45k as a junior doctor. She's on track to earn 100k plus as a consultant, and she will be able to provide excellent opportunities for her own children. And that protection left by the father is the first step in creating generational wealth for the family. All in all, one family's lack of planning destroyed opportunities for multiple generations. The other family's £38 monthly investment created generational generational prosperity. So let me break down the actual financial cost of leaving your children unprotected. So let's start with the educational impact. University costs in the UK are as follows. Tuition fees currently at £9,250 per year. Living costs anywhere from 12 to 15k per year, making the total cost per child anywhere from 65 to 75k. When parents die without protection, children often can't afford university. The lifetime earning differences between university graduates and non-graduates ranges from 200 to 300k. The educational impact alone could cost £400,000 to £600,000 in lost lifetime earnings. So what's the housing impact? Well, protected children often inherit a mortgage-free family home worth £200,000 to £500,000. This gives them immediate housing security, a valuable asset to leverage for their own property purchases, rental income potential, and generational wealth to pass on. On the other hand, unprotected children usually lose the family home and start adult life needing to pay rent instead of building equity, save for deposits while paying high rents, and compete in an expensive property market without family help. The housing impact could easily exceed between 300 to 500k over a lifetime. So now, one of the questions you might ask is, would this have an impact on my career as well? Well, let's see. Protected children can afford to take unpaid internships in their chosen field. They can also start businesses without worrying about basic survival. They can afford to take career risks that lead to higher rewards. And they can focus on education without having to work part-time. Whereas unprotected children often must work while studying, affecting academic performance, take any job available rather than pursuing their passion, support younger siblings instead of building their own careers, and make short-term financial decisions that limit long-term potential. And of course, it wouldn't be right if I didn't speak about the impact it has on mental health. The stress of inheriting debt and financial responsibility can create lasting mental health issues. For example, depression and anxiety rates are 300% higher in financially stressed young adults. Therapy costs also average £50 to £80 per session. Productivity is also lost due to mental health issues, and relationship problems are caused by financial stress. And then you have the compound effect. These impacts compound over generations. Generation 1, being your children, inherit debts instead of assets, have limited educational opportunities, have reduced earning potential, and end up with high stress and mental health issues. And that's not all, because you have Generation 2, which are your grandchildren. And in their case, it doesn't get simpler. Because what happens is, parents can't afford good schools or universities, they don't have any family wealth to draw upon, the cycle of financial struggle continues, and they have limited opportunities compared to protected families. And then we move on to Generation 3, which are your great-grandchildren. And then in their case, they're still feeling the impact of your lack of planning. The family remains in lower socio-economic brackets, and unfortunately, generational poverty becomes entrenched. Whereas conversely, proper planning creates generational wealth. Because Generation 1 inherits security and opportunities, Generation 2 benefits from parent success and stability, and Generation 3 inherits established family wealth and advantages. So the total cost of leaving children unprotected can exceed £1 million per family when you account for lost opportunities, reduced earnings, and generational impact. Now, let me show you exactly how to ensure your children inherit advantages instead of debts. Step 1. Calculate your protection needs. Use this formula to determine how much life insurance you need. This includes outstanding mortgage, other debts such as credit cards or loans, funeral and estate costs at, let's say, 10k, children's education fund, which could be 75k per child, family living expenses for at least 5 years, and an emergency buffer of 50k. Once you do all of that, you've got your total protection amount calculated. So looking at that, we would say most families need anywhere from 300 to 800k in life insurance coverage. Step 2, get life insurance immediately. Don't delay this crucial step. Term life insurance is perfect for most families. Choose a term that covers you to the age of 90, as it gives your family the greatest chance of receiving an inheritance whilst keeping costs down, and it gives you the chance to live as long as possible without having to forego leaving an inheritance. Speak to an advisor like myself so that you can have a policy tailored exactly to your needs and budget. This process takes anywhere from 30 to 45 minutes max, and coverage starts immediately upon approval. So here's some cost examples. 300k for a healthy 35-year-old could easily be between £25 to £35 a month. £500,000 for a healthy 40-year-old could be between £45 to £65 a month. And 750k cover for a healthy 30-year-old could be between £35 to £50 a month. Step 3, set up education funds. Create dedicated education savings. So you can set up junior ISAs for your child and invest up to 9k per child per year. Child trust funds, if your child has one, keep contributing. And education savings accounts, which are are separate from other savings. So even £100 per month per child from birth creates £30,000 plus by the age of 18, assuming a conservative 5% growth. Then you have step 4. Create a will and trust structure. Protect your children legally. A will specifies guardianship and inheritance. A trust protects the assets until children are mature enough to manage them. A letter of wishes provides guidance to trustees. And lasting power of attorney protects you if you become incapacitated. Step 5. Plan for care costs. Protect your estate from care home fees. So what you want to do is consider care insurance, look into property protection trusts, understand the rules around care cost assessments, and plan gifting strategies if appropriate. Step 6, which I'm sure is of interest to everyone watching, optimize for tax efficiency and minimize inheritance tax. Use both partners' nil rate bands, which is 650k total for couples, assuming they don't have property, and $1 million if they do. Consider life insurance in trust. Plan lifetime gifts of £3,000 per year allowance. Understand residents' nil rate band rules. An example of this would be the Thompson family. So the parents are 35 and 33, and they have 2 children aged 8 and 5. Combined income between them is 65k, mortgage balance is 280k, other debts is 15k, and their monthly disposable income is £400. A wise protection plan for them to go with would be 280k joint life cover for their mortgage at £14 a month, life insurance of 162,500 each, covering both of them to 90, so the kids can receive 2 payouts, given the fact that they have 2 parents and it's very unlikely that they'll pass away at the same time. And it will cost them £20 and £22. Of course, the older person will pay more because they're older. Then they can have junior ISIS for both children at £200 a month, so £100 each. A will and trust setup of a one-off cost of £800, making their total monthly commitment £256 a month to protect the financial future of their family. So this results in children guaranteed to inherit 325k minimum, potentially over 600,000 if the parents pass away whilst they're still a mortgage. Education funds of 40k plus each by the age of 18. Family home protected, all debts covered. Children start adult life with massive advantages. So many parents focus on saving for a university while ignoring life insurance. This is backwards thinking that could destroy your children's futures. Here's why protection comes before education savings. University funds without protection equals wasted effort. If you die without life insurance, any university funds you've saved become meaningless. That money just gets used for immediate survival needs. Your children can't afford to go to university anyway because they're supporting the family, and education becomes a luxury they can't afford. I worked with a family who had saved 40k for their daughter's university education. When the father died without life insurance, that money went to mortgage payments and living costs. The daughter never went to university. One thing to note is protection creates educational opportunities. With proper life insurance, university fees are covered from the life insurance payout. Children can focus on education without financial stress. They can choose courses based on passion and not just earning potential, and they're not under any pressure to get the first job offered to them. So let's look at the mathematics of priority. So consider this a comparison for a family with a £200 monthly budget. Option A, let's say university savings only. So they are putting £200 a month into an education fund. After 18 years, let's say that's 65k, assuming there was a 5% growth. If the parent dies in year 10, 31,000 is available. Child probably can't afford university due to family financial crisis as a result. Or option B, let's say they go protection first then education. £50 a month life insurance for 300k coverage, £150 a month education fund. After 18 years, £49,000 would be in the education fund plus £300,000 life insurance protection. If the parent dies in year 10, £300,000 is immediately available plus £23,000 in education fund. The protected child has 10 times more financial resources available. Life insurance provides advantages that university savings could never do. And these could be from the following: a mortgage-free family home, no family debt burden, freedom to take career risks, ability to start businesses, mental health and stability, and of course, generational wealth creation. So there you have it, the complete guide to ensuring your children inherit opportunities and not debt. So to recap, children inherit their parents' financial problems in hidden ways that most parents don't realize. The difference between protected and unprotected families is stark and measurable. Thirdly, leaving children unprotected can cost over £1 million in lost opportunities across generations. Proper protection is affordable and creates massive advantages for your children. And number 5, protection matters more than any university fund or savings account you could create. The choice is simple. Spend £30 to £80 a month for life insurance, or risk leaving your children with a lifetime of financial struggle. I've seen too many young adults whose futures were destroyed by their parents' lack of financial planning. Don't let your children be next. Remember, as parents, you will do anything to protect your children from harm. Financial harm is just as devastating as physical harm and is completely preventable. And I must say, your children didn't choose to be born. but you can choose what kind of financial future they will inherit. If you found this video helpful, hit that like and subscribe button for more financial protection advice that could save your family from disaster. And if you want personalized help creating a protection plan for your family, I work with a limited number of families each month. If this is something that you want to move forward with, click the link in the description and book your free consultation. Remember, set up a plan today, don't die for free. Your children's future depends on the decisions you make right now. Take care, and I'll see you in the next episode.